Rising energy prices have oil stocks leading the markets today. Marathon Oil, Devon Energy, Diamondback, and Occidental Petroleum among the gainers. Our next guest says oil prices could still go higher. Let's bring in Paul Sankey of Sankey Research. Paul, great to have you with us. BK says 150. You say 110 to 150. Structurally, that's where oil should go, you say. At what point do we hit demand destruction, especially as consumers are facing inflation in so many other parts of the economy?
Well, as you know, the U.S. gasoline price is still about half the level it is, for example, in Europe. And we still don't think that it's that huge a part of people's income. But you've been on fire today, and you've got the idea right, which is that the sticker shock is bad for Americans at the moment. Having said that, we're going into summer, and typically prices go higher into summer. It's not a whole lot more complicated than that. And with low unemployment, I think we'll have a pretty lively driving season coming up.
Hey, Paul, it's BK. So I'm curious, are there structural things that we're talking about that would keep oil prices higher? So I'm thinking, the political will not to have anybody drilling anymore, rerouting the route. So now Russian oil has to go through the Baltics all the way around and over to China. Those are the type of things to me that seem like they're going to keep oil prices elevated for a while. Am I right, or is there something I'm missing?
Well, I mean, the Russia thing is obviously just enormous. I mean, we're talking about, one of the big three, Saudi Arabia and US and Russia being, effectively out of the market now. And the way the Germans and the EU are talking, it's a real fool me once. They're not going to go back to Russian energy. So I think we've lost those barrels, and that's a very big deal. You've lost the natural gas, which is a big deal for European refining. You're tight distillate because you're short European refining. And all of this stuff looks pretty structural to us. So I think you're thinking about it the right way.
Paul, I wanted to ask you about gasoline and the notion that increasing the percentage of ethanol could help prices. Ethanol is made from corn, which is also very high in price and in shortage, or will be in shortage. And I'm wondering how you view the Biden administration's latest attempt to sort of ease the pain of the consumer, so to speak.
Well, we pretty much hated the ethanol mandate for 15 years now. Of course, it wasn't a Biden or a Democrat, for that matter. It was George W. Bush that originally pushed ethanol into our gas tanks, and we just think it's a bad idea. Ethanol is less efficient. As you say, it's made from corn, and we've kind of got a global food crisis here. So we don't like it as a policy. And, it may serve to bring down prices a little bit, but at the same time, you could easily be looking at higher corn prices, higher food prices, higher feedstock prices as a result. So it's kind of robbing Peter to pay Paul, as they say, and we don't like the policy.
Hi, Paul. Previously on the panel, we talked about the boom-bust cycle that seems very repetitive in terms of commodities and oil specifically. Would you mind weighing in a little bit in terms of how the advent of renewables starts to affect that boom-bust cycle going forward?
Yeah, I mean, I was really enjoying the debate, guys, earlier. You're all on fire. It's tremendous. But, I think the main thing that we've now established is that natural gas has a huge role in the future of energy for many, many decades to come. And I think there was a bit of denial about, putting natural gas in a fossil fuels basket and saying, let's get rid of all fossil fuels. And, the next thing that happens is, it's not an exaggeration to say, is that Russia invades Ukraine, assuming that, Europe is just overly dependent on them and really can't do anything to stop it. So it has huge consequences. And, we really think it's important to develop natural gas alongside wind and solar for a more stable energy future than we're getting right now. I mean, the shutdown of nuclear also makes no sense. So I think the cycle is going to last longer. We are worried about demand destruction. That's the key thing to think about. But at the moment, there's such little employment here in the US and the economy is still so hot. I think it's going to be a very hot summer.
Earlier, we were talking about pendulum swinging or things going back to the mean. And so, Paul, I'm wondering what you think the path is to oil going back to, let's say, $50 a barrel. I mean, is it that the big big oil companies start drilling again? I mean, what is the scenario under which that happens? They're
not lying. They're saying we don't have the people. We really can't drill any faster than we're drilling, and we're already increasing spending and activity. And if you go to Midland, for example, in the Permian, it's tight, drum tight. There's no labor available, very little steel. The list goes on. So they're not drilling, because there's spare capacity. They're kind of maxed out. And as a result, I don't think the supply side is going to bring down prices. I think it's going to have to be demand destruction. I'm afraid to say recession, maybe.
Paul, thank you. Always great to get your thoughts. Paul Sankey. All right, so oil stocks, Guy, favorites.
They go higher. You know, the last time, well, he's been on a few times. Paul was on around Halloween, by the way, and he mentioned MPC. It had a 64 handle, and I think collectively we said this should be an $85 stock. Well, look down at your Google machine today and see where it traded up to. This is a 3-year high in the name. OIH back to the 300 level briefly today, pulled back. All those names, specifically Schlumberger and Halliburton, they're better run companies today than they were at their previous peak, with oil at higher prices, and the stocks are still significantly lower. Those stocks should be higher, and I still think energy grinds higher from here, Mel.
Yeah, I mean, in general, if you want to get the energy trade, you can do it, through the refiners is one way to do it, or look at something like ExxonMobil, because right there, you're going to be getting a nice dividend also, and it's unlikely that that dividend's going to be cut in this environment. So that's probably another way to express that view on oil.
Yeah, and also chasing oil stocks here might be the most obvious thing to do, and maybe you want to fade them here rather than just pile on. That's just my take, but what do I know?
Always going
I'm a buyer.
against the grain.
Bring them.